Hey, this is Evan Hutchison, and today I want to go over the importance of a cash flow statement. And this is kind of a cash flow statement. It's one that I created. It's not your cash flow statement that you would see on a software program, which looks at your net income and then subtracts and adds different changes in cash. This is more a hybrid balance sheet and income statement that I'm calling a cash flow because it's used to control cash and budget into the future. So this is really one step further from your regular bookkeeping. So if you run a business and you have a set of financials, this I think is a good final step in that process after looking at your set of financials. And even if you don't run a business, uh, there's a few there's a lot you can do just with your personal accounts on this statement. There's a few sections that you would just delete and then you would go from there. So I think it's a great idea either way. Bookkeeping on its own is great for admin purposes. It's great for filing taxes, of course, and reconciling statements and finding errors and drilling down. You can make a lot of decisions based on your financials, but this is really where you go to make those key financial decisions. And if you want to create a plan for the future, if you need something a little bit more, I believe is where you would start. And like I said, it's not your ordinary cash flow. It's the top part right here, and I'm going to go through all this here in a second. But the top part is your balance sheet, essentially a summary of your balance sheet, your current assets, your liabilities, and your equity. And this equity is I think the most important part because this is what you're trying to increase over time. You want to increase your equity. You don't necessarily want to increase your cash. You might have a whole lot of cash right now and then buy a house with all cash in a year, and then of course your cash drastically decreases, but that's not necessarily a bad thing. So you're wanting to increase equity, and that's kind of what we're going to look at a little bit more. So we want to figure out you want to figure out maybe 20 years from now or 30 years from now or 10 years from now, just at some point in the future, where you want your equity to be, and then you're going to manipulate these numbers to both be something that's doable and to create that needed equity at that time period. So you're gonna, and here's the profit and loss, the business profit and loss, and the personal profit and loss. So you're gonna create these budgets in here to try to track, to try to follow, and then drag out these budgets to a number of years to see where your equity would end up. So if you want to have $1 million in equity by the time you're age 60, you would figure out, because you want to see how much it's going to increase each month, and then because you're going to do a systematic approach where it increases a certain amount each month based on your formulas, and then you can just drag it out. You'll be able to figure out when it'll reach that $1 million point, and maybe that's where you decide, all right, when I have $1 million in equity, I'm not going to want to necessarily retire, but I want to slow down a little bit. I want to travel a little bit more. And then, of course, you can also create something right now that will set a budget in place that will allow you to travel right now. I mean, there's a lot of stuff that you can do with the statement, and you really just want to figure out what you yourself want. Do you want to stop deferring your life right now, start traveling all the time, have equity to make that work? Well, you got to start messing with these numbers to make it work. And then once you have the numbers in place, you've got to make that work. So once you have the budget in place, you start inputting the actual data, and you can then determine, all right, is this data doable, or am I consistently over budget? Is it just not working at all? And that's when you got to make some decisions, whether it's cutting expenses or whether it's being more practical with your budget. Whatever it might be, over time you'll be able to make decisions. So this particular person put in May's actual, right? And then their June budget is based on, and you could work this, you can make a few changes with this spreadsheet to make it work for you. But this person, all right, they're starting really at the bottom with the P&L, trying to figure out where their business is at, where their personal is at, and as a result, it's influencing their cash accounts. So for instance, business checking. the actual balance at the end of May was $15,000. The June budget is going to start with 15 and then add the business profit and loss. So you see the formula right here. It's B6, which is this cell, plus C43, which is this cell, which is the business profit and business net income. Now, if you understand accounting, you know that there are some portion, there is cash going in and out that does not necessarily affect business net income. So this is not actually a profit and loss statement. It's a summary of a profit and loss that also includes some balance sheet items that affect cash. So for example, if you buy a piece of equipment for $10,000 in the month of June, that equipment is going to go on your balance sheet. It's not going to go on your profit and loss. It's going to go on your balance sheet for purposes of your financial statements, but for purposes of this statement, you're going to add it in these expenses right here. So you can get an actual display of your cash going in and going out. So what you want to do is at the end of each month, you look at your balance sheet and your P&L, and you just make sure your cash is all flowing through to this statement. And I can help you with that. Your CPA, I'm sure, can help you with that. But once you understand how to do that, it's going to be really easy moving forward. It might trip you up a little bit for the first month or two, but once you kind of consistently understand it, it becomes a lot easier. And a lot of times the cash coming in and going out is just your income statement on a cash basis. So there might not even be any issues at all. But just be aware that sometimes there's some balance sheet items that might affect this that you'll need to, the step one is looking at your balance sheet and your income statement from your financials, and then transferring the income statement over, and then transferring the changes in cash over. So another example might be accounts receivable. If you sell something for $5,000 but you haven't received the money yet, you have an AR of $5,000. Well, if you look at your profit and loss statement on the accrual basis, it's going to show $5,000 of income. So that's why you want to, for purposes of this statement, you want to look at your cash basis profit and loss statement and then add in some of those factors that even on a cash basis won't show up on the profit and loss, like the equipment that I just mentioned. So if you import, or however you want to, if you input the business P&L, and the business P&L of course will be more than 4 line items as well. So if you really want to study your profit and loss statement, don't do it on here. This is just a summary. This is just kind of breaking it down a little bit more than just one line item, just so you can see that, all right, $9,000 went to employees expense, $250 went to other stuff that we're not worried about. When you really want to drill down, you use your business financials. This is just a summary, but this summary can go a long way. So your business income, your expenses, you put those here, they come up with a net income. The net income, 3758, is added to your prior month's actual data to get to your budgeted cash. Same exact thing with personal checking. This is prior month actual plus personal net income. So your personal net income is down here, and it's essentially all your and I'm doing a little bit more detail for personal, just because usually with the business profit and loss, you have, you're studying that within your business account. You're trying to drill down in your business to figure out what expenses can be altered, if any. Personal, I'm kind of using this spreadsheet for drilling down on personal, and that's why I have more detail here, because there's a lot more wiggle room when it comes to cutting expenses and things like that. And that's the overall theme of this spreadsheet, is to try to decide what you can do to create the equity that you want to create at a certain point in time. So the business, that's a review all on its own in the business books. This statement is more for you financially as a whole. So that's why I have business kind of summarized here, because you do that on your own. Personal is more broken down, because you're going to use this you're going to use these accounts more to decide what you want to do in the future. So these are personal expenses. I suggest using, if you use QBO, if you use QuickBooks Online for your business, you might add a separate one for your personal. And for your personal, you don't have to add anything on the balance sheet because it's strictly for this spreadsheet. So for example, investments into Acorns app. That's really an asset. You're really increasing your asset, your Acorns investment asset. But we're putting it as an expense on the personal side. Just because the only reason we're using this personal QuickBooks is to import it into this program. So we're putting everything in expense, and that way we can easily import it here, and we're going to show the asset in a different place. So for example, for Acorns, we're averaging or budgeting $110 to go to be pulled from the personal checking and put into Acorns. So we're actually looking at the asset on this spreadsheet. So the Acorns asset is right here, and it's essentially taking prior month actual data, adding in the C57 right there. We're subtracting the negative, so we're adding it in, C57. We're adding in this $110 to the prior month, and then we're multiplying it by how much we think it's going to grow each month. So that's how we come up with this number. We add those and then we multiply them by the growth rate of 6% per year, which is 0.8% per month. We do that with Robinhood investment. Coinbase is so volatile, I wouldn't even, that's cryptocurrency. I would just kind of keep that there just to keep it there so you can keep an eye on it, but who knows what's going to happen with that. Roth IRA, we put $6,000 in, and it's growing a little bit over time. And this is just something that this is just showing you what you could also add to this. You loan a friend some money, it's going to show up right here. In July, they pay you back. So this asset goes away, but as you can see down here, the personal net income goes way up because of the $60,000. So they pay you back. It doesn't really affect equity because it decreases the asset right here, but it increases the asset right here. So the equity stays the same. So that's what I was kind of saying earlier. When you make a big purchase or collect a lot of money, it'll have a big impact on your cash, but it won't necessarily affect your equity. And that's the bottom line. That's what you're really trying to increase. So what we're doing here is we have the plan is to take, we have the budget drawn out, right? The budget each month. It's based on the previous month budget plus growth plus changes. And these growths and changes are consistent each month. That's the formulas in place, so we just drag the formulas over. So if we drag, so you can see right here, just from the budget, the equity, if this person's financials end how they expect their budget to end, the equity at the end of the year has gone up to $315,000 from $260,000. So that's a pretty good increase, and you can see if we keep dragging this over for another 5 years, it'll increase that much more for each year. So you can kind of get a good idea where you are in 2030 if you want to look at 2030, 10 years from now. But to really have a good grasp on it, you need a few months have to go by to make sure that your actual numbers can kind of agree with your budgeted numbers, or if you need to make some changes to your budget. So we're doing actual June right now. It's as of this video, it's June 18th, so we can't really do actual June, but we're just going to guess. Just going to put some numbers in to display what's going on. So if we look at, we want to start with the profit and loss part, because the profit and loss is the profit and loss. The cash can be formulated to come up with the correct numbers based on the profit and loss. So if we go to the profit and loss statement, let's say we looked at the cash basis income for the business, and we budgeted 25 grand. It was actually 26 grand. So we put 26K there. We budgeted 9 grand paid to employees plus payroll taxes and benefits and all of that. Let's say we were right on cue. Everybody's getting salary. We already know what they're getting, so we're at 9,000. Software and website, maybe we found something that we wanted to purchase that we weren't aware of, so we're at 4,600 because we spent an extra $300. And then operating, let's just say we're at 250. So this number right here, guaranteed payments, this is for somebody who has a single member LLC. So the guaranteed payments are actually payments to themselves from their from their business to the personal. So we could make the formula, this cell right here equals this cell, or this cell equals this cell. It doesn't matter. It's a transfer of money from business to personal. So when we do the personal income, we see that the business transferred to personal, let's just say $10,000. So if we put $10,000 here, that adjusts the business. We want to make sure that actually matches, of course. What if we look at the personal income and we see 10,000 going through your personal income account or your personal bank account, but business actually transferred 10,000 to personal checking and then 2,000 to personal savings. We just want to make sure everything kind of jives, and we can correct that when we see it. But this will also, when everything jives, that's a good thing. Everything's consistent. You want to make everything consistent, so you can see little faults in the way you're doing things if this cash flow spreadsheet doesn't quite mesh well. So if you see that money's being transferred to personal and money's being transferred to savings, I think it's good to have things consistent. So maybe transfer everything to personal and then transfer some money from personal to savings. Or you can do, if you're more comfortable transferring money to both personal and to savings, you're going to want to add the savings account to your personal QuickBooks file or whatever software file that is, and then your income can include both personal checking and personal savings, if that makes sense. You're including two bank accounts on your personal financials, and the money going in from your business account to both of those personal checking accounts both go to income for personal. So it's just such a, there's many variables in place. You just want to make it work for yourself, and whatever it is, just stay consistent with it. So this person, let's just say they transferred 8,000 to personal checking, 2,000 to personal savings. We want to make sure the personal financials have the savings account and the checking account in there, and we're showing 10,000 altogether. So it does match. And then we'll say that, let's just say for purposes of speeding up this section, everything was right on budget. Of course, that's never going to happen. So you usually want to type it out as you're going, but we're going to say that now. We'll say legal and professional is an extra $800 since I just did a typo. Okay, so the net income from personal is now 3,218. You'll see that the personal bank account is 5,000 plus 3,218, so now it's 8,218. Your personal savings just went up $500 because of that $500 transfer to savings, which is right here somewhere. Transfer to savings right there. So just keeping up with the personal P&L and the business P&L, not only can you, now you can compare budget to actual P&L, which is great, a great tool to use to figure out where you might need to trim costs, but you also have a full-blown financial statement, a profit and loss, a balance sheet, all in one page for your personal and your business. And you also have a cash flow statement. You can see where the cash is, where it was, what's happening to it, if it's increasing, if it's decreasing. And you can see the same thing with your assets, your other assets. So you get into your Acorns investment account, you realize, all right, it's actually, COVID happened, stuff is going crazy. This month it went way up maybe. So let's say it's at 1,800 instead of the 1,600 that we budgeted, which will probably mean Robinhood is sort of the same, since the market moves, the stocks are pretty correlated to the market as a whole. So let's just say this is 12,000 Coinbase. We're just going to keep here. Roth IRA, we'll say 6,100, and we still are owed money from a friend. So right here, all these numbers are accurate. In theory, of course, you might want to check your accounts, make sure they match, but they should be accurate if you're doing everything correctly. If they're not accurate, then you know there's a mistake somewhere on the spreadsheet, or there's something that needs to be added to the spreadsheet or removed from the spreadsheet. You also own a house, maybe you got an appraisal, and you're not going to get an appraisal every month, obviously, so you can kind of just increase this based on where you're living, just increase it a little. I'm doing 0.003 per month, but we'll just call it whatever the budget is for now. Chase credit card, this is maybe a personal credit card, so the personal expenses are included in your personal P&L, but the payments to Chase decrease the liability, and of course the expenses increase the liabilities, so you'll just have to look at your Chase statement after a certain point in time and input that here. And then the mortgage, you can just look at your mortgage statement and get the balance at the end of each month. Let's just pretend like this person did an amortization schedule, so he already knows his balance. And we've got the full balance sheet filled out now. We've got the balance sheet filled out, we've got the income statement all ready to go, everything's good, so we know the equity's good. So we have equity of 271,000, which increased 10,000 from the prior month, which is a good month. You know, you want it to keep increasing, of course. I mean, I guess it's relatively a good month depending on who you are, but now what you have to do, these budgets are based on growth each month, based on the prior month's budget. Since we now have June actual, there's no reason to use June's budget as part of the calculation. We have the actual data, so we need to use the actual. We should use the actual. We might as well use the actual. So July's budget, the numbers, as you can see, C6 plus E43. C6 is the budgeted checking account. E43 is the business P&L, right? So this number right here, 3578. We need to change that. We need to change that to June's actual plus the budgeted P&L. And we're gonna have to do that for all of these items because we may as well use the actual data. It's more accurate. So all we need to do, and maybe if you're an Excel guru, there's a better way to do this, but what I typically do is just do that. As simple as that. Just change the formula like that and do that down the line. So if we do that, we are getting real numbers in to start to get the budget going, and then the budget is of course based on the prior month's budgets moving forward. So this kind of gets things accurate moving forward, but after you get done with this, you still want to compare the budget to actual to see where you're off. And 1 month isn't really going to cut it. Maybe after 3 or 4 months, you know, you're never going to have it perfect, but just look at the trends that you have going on in your budget versus actual, and you can, in the complex video, the more complex video that I'm doing, I can go over that as well, just what other, an extra kind of spreadsheet that you can do to compare trends and look at key ratios and things of that nature. I'm going to try to, here, I'll cut the time by pausing the. So what I really just did was just change all the C's and the formulas to D's pretty much in this budget. And then we still carry, and then the August is based on July. So you can actually, if you wanted to, you could just keep bringing this out as I mentioned. So we're at the 2020 December budget, and we can take this and just keep dragging it. So if we want to go all the way to December 2022, we can see what happens. See where where we think the cash will be, where we think the assets will be, and really most importantly where we think the equity will be. So we have equity of 583. That's what we're striving for. And I think it's attainable, and you should think it's attainable as long as after a few months you start comparing your actual to your budget and you see that it's pretty well correlated. Of course, as everybody knows, the markets can do a lot of weird things, so nothing is ever a certainty, and that also, of course, creates some added complexity and added uncertainty to your financial statements. But you can drag this out as far as you want to go. So if you think maybe at age 60 you want to have $1 million, as I mentioned earlier, in equity, drag it out and see if that happens. And if that doesn't happen, then make some changes to make that happen. And if you think that these changes are completely unreasonable, then you need to come up with a more reasonable goal maybe. But this will I think this could help a lot with at least having some sort of vision in place, because it's good to have a vision, and also for that vision to be practical and something that you want to strive for. So I hope that helps a little bit in understanding cash flow and what you can do with your financials to make them work for you.